Financial markets share a structural feature with Ponzi schemes: later money pays earlier returns. But real value creation and regulation separate them. This is the sharpest, most counterintuitive view, yet in a sense the most true. Let's examine the mechanism. At its core, a Ponzi scheme pays returns to early investors using money from new investors. There is no underlying business generating profits. Financial markets, in their price discovery function, also rely on new buyers to push prices higher, enabling earlier buyers to sell at a profit. This is not fraud, but the mechanics are parallel. The difference lies in the presence of real value creation. A Ponzi scheme has none. A market, at least in theory, reflects the discounted value of future cash flows. Yet when growth stalls, the market's reliance on new money becomes more pronounced, blurring the line. When economic growth slows and corporate earnings stagnate, the only driver of rising stock prices is new capital. This is exactly what happened in 2020 to 2021, when central banks created trillions of dollars. That money had to find a home, and equities absorbed it, pushing valuations to extremes. Every investment ultimately relies on finding a buyer at a higher price. This is the greater fool assumption. The formula captures the idea that your return depends on the next buyer's willingness to pay more, not just on the asset's intrinsic value. Even value investors, who claim to ignore market sentiment, must eventually sell. The exit price depends on another market participant's willingness to pay. Thus, the greater fool assumption is embedded in every investment, regardless of the strategy. Liquidity is the ability to buy or sell an asset without causing a large price change. It is built on confidence and capital. The formula shows that market liquidity is a product of the total capital available and the confidence of participants. Confidence is the belief that others will continue to participate. It is psychological and can reverse suddenly. When it does, liquidity evaporates, and prices collapse, regardless of underlying value. This is why markets are prone to crashes. When markets rely heavily on new capital, we can think of a Ponzi Premium, the portion of an asset's price that is not justified by fundamentals but by the expectation of future inflows. This premium is a measure of fragility. This chart illustrates the relationship between market liquidity and asset prices. As liquidity increases, prices tend to rise, even without changes in fundamentals. Conversely, when liquidity contracts, prices fall. Understanding this structure changes how you invest. You must respect liquidity cycles, not just fundamentals. Diversification and cash reserves become tools to survive liquidity droughts. And you must always ask, who will buy when I sell? Financial markets are not Ponzi schemes, but they share a structural dependence on new capital. The greater fool assumption is real, and liquidity is the lifeblood of prices. As an investor, you must respect this reality. Diversify, stay liquid, and always have an exit plan. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.